So as far as the changes in our buy box criteria, in the past, we were very cap rate driven. So day one cap rate. And then once we got a little bit more sophisticated, then we started looking at what will the cap rate be in 12 or 18 months? And that caused a lot of deal flow to come into our funnel. So we look at maybe 20 to 25 deals a week now. That's a lot of deals to underwrite. So we have to triage them in a certain way. Now that we're kind of growing up, if you will, we notice that it's more a game of arbitrage than it is a game of day one cap rate. So what can I make on this deal as a spread over my financing cost? And as long as it cash flows and it hits those metrics, then it makes sense for the scale. So one of the things that we noticed very recently as we've been building these portfolios is that portfolio of 10 properties, when I bought those, I underwrote them with an exit price of an 8 cap. But then just by combining them into a larger portfolio and then reaching these larger buyers that have much lower cost of capital than, say, a one-off buyer, all of a sudden the cap rate starts dropping. So now there's a way to make money not only from the individual facility itself, but from the volume of combining multiple facilities together. So we need to get deals into the hopper and put them together into that portfolio. So now, like I said, and I alluded to, some of these buyers, they're going out and they're getting 1.5% to 2% debt. And then they're going and raising the equity on the bond market in Europe that has negative interest rates and offering maybe half an interest rate. So their combined total equity cost, equity and debt cost, is something like 1.8 or 2%. So it makes sense for them to go out and buy things at a 4.5 or a 5% cap rate because they're still making a 300 basis point spread on their capital. They're doubling their money. So it doesn't matter. So I just looked at what these big boys are doing and say, hey, why can't we also do that as well? How do we find lower cost of capital, both on the debt and the equity side, so that we can start making more aggressive offers?